Perhaps you could start us off by telling us, what is the global casino?
Back in the day, I ran a global campaign for the cancellation of the debts of the poorest countries, or helped run. And then in 2000, I joined the New Economics Foundation because I was very concerned about the climate. And I was deeply frustrated also because it seemed to me that environmentalists operated in a silo called the environment or the ecosystem. And economists were over in another silo, and there the twain should meet. And I thought it was so that the two are so closely integrated. And at the time, I had a real hard time persuading my fellow people, comrades, colleagues, that really we had to integrate these two things to understand why we had the climate crisis. So that's really what I'm about. My bias is towards the financial system because I'm obsessed with it largely because of my background in sovereign debt. So that's why I'm here. And this latest book is about the way in which the international financial system is structured to make it really difficult for governments, states, never mind individuals and movements, to actually impact global markets in energy and money, basically. So the key achievement of, people call it neoliberalism. I don't know what it is. For me, it's old-fashioned financialized capitalism. The key achievement is that markets in money and energy and food have been detached from any democratic oversight, basically from any regulatory or democratic oversight. And this is so striking in the case of energy. And in my book, I show that there's one market for energy, essentially one market, and that's the Chicago Mercantile Exchange, which most people have never heard of. But if you learn nothing tonight, if you learn about the Chicago Mercantile Exchange, I'll be very pleased. And in that market, traders gamble essentially with the price of energy. There are two types of traders in that market. There are what are called the wet barrel traders. These are people who produce oil, buy and sell oil. They might need to buy oil and they might need to sell oil, but they're in the real business of trading oil. They're the wet barrel traders. But they are outnumbered hugely by paper barrel traders. And paper barrel traders are people who speculate on what's going to happen to the price of gas and oil and so on and so forth. And their role in that market is to bid up prices or to bid them down, depending on what bets they're taking, whether they're betting up or whether they're betting downwards. So what we see is that, for example, right now, we're told that the oil price has fallen. And sure enough, that's what speculators are arguing, that they expect it to fall. But in the real trading world, the price of oil is not $75, which it is in the financial markets. The price is probably much higher than that. So there's a big divide between those two groups. But in 2000, Clinton and Alan Greenspan, who died this week, and Larry Summers, friend of Epstein, all of that, they got together and argued that it was necessary to deregulate the commodity markets, and in particular the market for energy, and that's what they did. And they were opposed by a woman, Brooksley Bourne, to whom they were extraordinarily insulting when she said, I think we need to regulate these derivatives, and she failed to do that. And so as a result, the price of energy is subject to these kind of crazy market forces and these speculators. So if Ed Miliband wants to do anything about the price of gas or oil, his hands are tied. He can't do anything about it. And it just makes politicians look pathetic, really. And I can see him trying. I can see what he's trying to do, but his hands are tied. He cannot do very much. I worked in Africa for a lot of the time, and Nigeria has been modernizing its energy production. It's tried to move from being just an oil producer and to become and they're building an oil refinery, and they are self-sufficient in oil. And now the World Bank and the IMF are saying, no, you have to allow imported oil to come in to basically parallel the global market price. You can't have a local price. You can't use your oil and the price of your oil to keep your economy going, right? You must import foreign oil. And I don't know if the Nigerian government is going to capitulate to this, but the American government has, So American producers have been getting a massively high price for a barrel of oil over the Strait of Hormuz crisis. But American consumers are paying the global price for petrol, essentially. And so America, that is also overflowing in oil and gas. They have more oil and gas than they need. They export quite a lot of it, have no power over the price or the subsidies they may be able to apply to those. And this really matters because so long as you can make money from speculation on oil, for example, it's going to be very tempting to not carry on doing it, really, because it is so profitable. So I want us to understand that this is what we're up against, really. And what I would like for people in the environmental movement to be saying, look, we want to have domestic autonomy over the sources of our energy supplies. We want some autonomy, some role over it. But we don't have that, and we leave it to speculators in global markets. And of course, it's even more serious in the market for food, for basic commodities like rice and soya beans and so on. Similarly, bought and sold in the Chicago Mercantile Exchange. So this is really, this is where we can see that because we can't manage these really important commodities, important to the stability of A, the ecosystem, and B, the economy, we've lost that power. And people have become disillusioned with governments naturally because of that lack of power. So that's, one aspect of what I want to talk about. But really, the big story is that the financialization of the global economy has really been achieved because the markets in money have demanded and have won the power to cross borders without any friction whatsoever. For traders trying to buy and sell stuff, even in the so-called world of free trade, which, by the way, it's not free, but anyway, even in that world, traders encounter frictions at borders. And we've seen that with the EU and so on and so forth. Travelers try going to Brussels nowadays and trying to get on the Eurostar. You have a really hard time getting through several border checkpoints, right? Capital faces virtually no such inhibitions, no such friction. And that has given capital markets enormous power over economies. I want us to understand that because until we're able to manage capital flows, we're not going to be able to manage what is happening to our economies. And one of the aspects of the macroeconomy that I think is really important in environmental terms, and I'm sure many environmentalists it hasn't really occurred to them before. Indeed, there are arguments about this I have with environmentalists, is the rate of interest. The rate of interest is an incredibly important metric. Because if you're an investor, you need to borrow money to invest. If you want to build a wind farm or you want to, be building flood defenses because you've got the staff and the skills to do that, you have to borrow money invariably to set up your company and to get going. But then what you need to do within our capitalist framework is to make enough money to make a profit from that investment over time, maybe not immediately, but over time, and enough money to pay back the borrowing and also make a profit and also keep your staff employed and so on. Now, the higher the rate of interest, the higher the cost of capital to investors, the more they have to extract, if you like, from the ecosystem to repay debts. And if we think about it in global terms, if you think about Brazil, if Brazil has to repay debt at high rates of interest, she has to strip the Amazon forest. She has to fish the seas surrounding her coast. She has to degrade her land by growing soya beans, right? In order to repay foreign debts, because she's now been persuaded that actually she must engage in these global capital markets. And until we as environmentalists understand that, capitalism is going to go on extracting assets from the ecosystem at really usurious rates, if you like, of interest. Now, key thing about the rate of interest is that it's an arithmetical number. It rises arithmetically. It can compound and rise exponentially. But nature doesn't work in that way. Nature does not grow arithmetically, and nature does not grow exponentially. Nature goes through a process of maturing, reaching maturity, dying, falling down, and effectively nature's rate of growth is really sort of quite flat. And yet we're using money to distort that and extract more from the ecosystem than we should do in order to be sustainable. So that's why I'm sort of passionate about environmentalists understanding that, So the global economy, as the way it's currently constructed, is a creditor-based economy. It's organized in the interests of creditors. And there's one thing creditors really like, and those are very high real rates of interest. If you've got money to lend, there's nothing nicer than saying to your borrower, it's going to cost you 4% plus or 5% plus in real terms, taking inflation into account. Because all then you have to do is to lend your money and sit on your butt and collect the rent. The rent on the money is the interest, right? And it's much easier than buying a London property and collecting the rent from poor students who can't afford to buy their own place to live. And yet we don't regard the rate of interest. And many environmentalists think we have to have high rates of interest to tackle inflation. I'm not quite sure why they think that. But low rates of interest, for me, is a fundamental tool in the economy for dealing with the ecosystem. And until we think about those things, it seems to me we're going to be victims of a system of capitalism that is extraordinarily extractive, really. And then there's the other point. In my book, I tell the story of Rockhammer, which is an oil company that wanted to exploit oil off the coast of the Adriatic coast in Italy. And I tell the story because I think it's important for us to understand how capitalists think. This theory was developed in the 1920s by a man called Irving Fisher. And he argued that actually what was really important about an asset was not the asset itself, but the rent that it generated. And he gave the example of the orchard, the apple tree orchard. And in the eyes of the capitalist, what matters is not the land, is not the apple tree. What matters are the apples. Because every year you can harvest the apples and make money. That's your rent, if you like, from the apple tree. When the apple tree degrades and it doesn't generate enough apples, you destroy the apple tree, you pull it up, and you decide you've got to invest something else in that land that will generate rent in the way that your apple tree has done. So there is a kind of a disregard, actually, for the assets like the apple tree. I work with a wonderful group of architects called House Europe. And they argue that we shouldn't be pulling buildings down. We should be reusing them, essentially. But capitalism sees no value in that. Capitalism wants to strip down this building, build a fancier building, higher, more taller, higher building, more rented space, and collect even more rent, right? So this is a really important dynamic. And I can't tell you how important it is to economists, and to the calculation of value for economists. And we have some really evil economists who've kind of created this financial system and this system that have helped capitalism develop the system. One of them, and I will name him, is William Nordhaus, who is been a really powerful influence on the IPCC, right? And I explain in the book exactly why, which I won't do here because it's quite complicated. It's something to do with the net present value of your asset. How, on the one hand, you worry about your apple tree. On the other hand, when you're calculating the losses into the future, you discount those losses because $1 today is worth more than $1 in the future. Right. That's complicated, but one of the things that drove me mad when we were trying to cancel debts was that the big creditors like the IMF and the World Bank would say, if you write off these debts, then I'm going to make a loss of such and such. And we would say, yeah, that's no big deal. But the loss that they would make would not be the value of the debt today. It would be the potential value of the debt in 30 years' time. And so they would say, if we want to discount, we want to create the net present value of the debt in the future. And that means actually we need to be compensated a whole lot more than we are being compensated for our losses. So in the case of Rockhammer, they wanted to dig for oil on the Adriatic coast. And there was an uprising on the coast. The citizens opposed it. And eventually the government supported the citizens and said, no, you couldn't have planning permission to do that. At that point, Rockhammer had invested something like $2 million in exploration costs, essentially. And you'd think they'd demand compensation of $2 million because the public and the government had abandoned this project, having invited them to do the exploration in the first place. But no, they said, what we've lost is not just the $2 million, but what we would have made if we had gone ahead with this investment. So government of Italy, you owe us $184 million, I think it was, that they were given in compensation.
That's right.
It was obscene. But they succeeded. The Italian government felt they had to do that. That's the law of the apple tree, Irving Fisher's law. So when you understand that economists have created these conditions which take exploitation and extraction that worsen extraction of the ecosystem. And then, of course, there's just the simple, straightforward story that companies like asset management funds like BlackRock, I have a real go at the chief executive of BlackRock in the book, because 5 years ago he gave an interview to Gillian Tett on AFT and said he had 7 grandchildren and he was very worried about their futures. And he goes fishing somewhere in at Idaho or somewhere. And he was horrified because the salmon had been killed off in the river where he'd always gone fishing. And furthermore, there were wildfires in the tundra not far away from where he went fishing. He found this was outrageous. And so he was committing BlackRock to joining the net zero, whatever it was the corporates had set up for themselves. Yeah, so 6 years later, the Texan Republicans have a go at him and say, we're going to be very unkind to you because you're following net zero. So his poor grandchildren get abandoned in favor of Texan Republicans, right? But they manage, BlackRock manages $13 trillion of our assets, of our financial assets. Your pension fund might be in BlackRock somewhere, right? And they can choose where they buy and sell stuff, essentially. And they choose to invest the asset management funds, and I mustn't over-egg this pudding, because they invest something like $1.3 trillion of those assets in fossil fuels, right? And those fossil fuels are hugely profitable. Clean energy and wind farms are not profitable. It's a really big problem. Brett Christophers has written this book, The Price is Right, about how unprofitable it is to grow clean energy, really. And that's why the state should be subsidizing it and so on. So these companies, I say, are now operating in those markets very deliberately away from any regulatory oversight. And I just think we have to understand that, because if we want to do something about this system, we really can't do anything if we don't understand how it operates, really.
You have that anecdote about Larry Fink and backtracking on those promises, and also this point about solar and wind now being really cheap compared with fossil fuels,
Yes.
arguably less risky, but as you say, not profitable. And you say we need to understand that. I was interested to kind of ask you maybe what you think the climate sector misunderstood in this way, because it does feel like there was this period of optimism of private sector leading on a lot of different green initiatives. And there's almost been a whiplash in the past couple of years as these kind of moments have happened where companies drop out or, I mean, we're just not seeing the divestment from fossil fuels that.
No, and we're not seeing the investment in clean energy. So I have the last 3 years been on the Scottish Government's Just Transition Commission and had the privilege of travelling around Scotland to Aberdeen, the oil centre of Scotland, the fossil fuel centre of Scotland, but also meeting people involved in wind farms. And they want to have the government fix the price of their energy for them, and to keep that price high enough to make it worth their investing. In other words, this is total, your government subsidies totally for the sector before they were willing to invest. At the moment, because it's so unprofitable, they're getting out of it. The Danish companies that were building these huge, what are they called, wind generators, are not doing it anymore. It's just not. There's just not the sector is dying on its feet unless it has these government guarantees. Having said that, we had a wonderful experience. We went to the Isle of Lewis, and the Isle of Lewis had a small community organisation that had their own wind farm. And we thought, oh, this is wonderful. They'd had to build a concrete road and cover the peat with huge quantities of concrete in order to be able to bring all the kit to the Isle of Lewis. So it had been and they had to borrow money from a Spanish bank because no British bank would give them the money for that. And they built this thing, and they were using the proceeds from it to invest in the community. It's all very worthy. And then we talked to the people in the community, and they said, we hate this wind farm, and we hate all the wind turbines that, in the bottom of our gardens. And I'd say, why? Well, because, they're making loads of money with whatever they're doing. I'm paying, said one little shopkeeper to me, £5,000 a year for energy, she said. And that's as much as I make from tourism in the middle of the summer. And that's the only time I make any money. So the hostility, but the extraordinary thing was when the price of energy, especially of gas, because gas determines the price of all energy, went up was very high. The community wind farm was collecting that price, making a lot of money out of it. But the citizens were losing out. It was really an extraordinary insight into what it's all really about, and how we somehow have to get out of this trap that we're in of global markets in energy.
Conscious we should get to questions soon. There's just a couple of things I wanted to ask you before then. One was just to talk a little bit about the section of your book that covers the insurance sector, because I think that might be quite interesting to people. You kind of talk about insurance companies almost, I think you say, playing past the parcel with high-risk investments in a way that might end up actually magnifying harms.
Yeah.
For example, from climate-induced extreme weather events, instead of protecting people. Could you talk a little bit more about that section and where you see that's building to?
I mean, the insurance markets are like all the markets in money, really. They've all got, their motivation is to make capital gains. And the other thing that's really extraordinary about today's capitalism, and I wish we would really fight this really publicly, is that they're extraordinarily risk averse, right? They don't want to take risks. So the dominant ideology at the moment is de-risking. BlackRock will not invest in something unless the government guarantees that. Now, that isn't capitalism as far as I'm concerned. Under capitalism, you're supposed to take risks. And if you make losses, then the markets discipline you and you're careful about your next investment. You don't take as dangerous the risk, right? That's the whole point of capitalism. However, if your risk is successful, you make loads of money and you're rewarded for that. That was the principle. That's the principle of free market theory. Now the principle is I don't take any risks unless the taxpayer guarantees what I do. Now that, for me, that's kind of Soviet-style capitalism. That's what the Soviets did. They guaranteed all their corporations that they would not make losses. At the moment, BlackRock and companies are saying we do not want to make losses on investment. We don't want the government, we don't want the public sector, for example, to invest in Africa or in greening forestry across Africa or anything like that. We want to do it, but under no circumstances must we be allowed to make losses. And I think we should mock them for that, really. And it's kind of spineless stuff, really. Give me a real old capitalist who's willing to take risks and who goes and does something and makes something that's productive and generates activity. Wow, you could admire that. But these spineless capitalists that have to have everything guaranteed, I think we have to mock them, really, for that. So I'm wandering off your point a little bit, but insurance companies are pretty much like the rest of them.
Maybe this can kind of be a jumping off point for questions, but I'm sure people would like to hear about what you propose to do about all of these issues and what some of the solutions are. To give a really quick outline, you kind of talk about decentralizing the global system, trying to kind of regain state sovereignty over markets, right?
I have just one solution, and it's crude and it's controversial, but for me it's the only solution, and that's capital controls. Right. I don't want to call it capital controls. I want to call it managing capital, cross-border capital flows, in much the way as the CEO of Apple manages investments in or out of Apple. I want us to be talking about it because until we manage the flow of capital across borders, we're not going to be able to manage the rate of interest. We're not going to be able to manage investment. We're not going to be able to manage energy prices. We're not going to be able to manage in government investment and so on. And for me, that is really one of the most important solutions. The other solution is to get over the ideology that what matters more than anything else in the world is fiscal policy, right? And fiscal policy is taxation and what the government does spend. There is no talk amongst Greens or anybody else, really, on the left, I'm generalizing massively here, of monetary policy. And, that is so carefully what the right want us to do. They want us to say the Bank of England and monetary policy is arcane and obscure and difficult, and you really don't want to go there. But please focus on wealth taxes, focus on fiscal rules, make sure you talk about fiscal policy all the time, and you never address the question of monetary policy. I'm getting cross here about this because it's so blatant a strategy by capital, if you like. Because the Bank of England, which is a very powerful institution, is the foundational power of the state, has been usurped, it's being captured by foreign capital markets, global capital markets. And we don't talk about that because we're worried about wealth taxes. And I want us to open up our minds to the fact that the solution to our autonomy is both fiscal and monetary coordination. And I'm involved with a really wonderful project in Europe called Prosper. And what they're trying to do is to sort of draft something like an equivalent of Project 2025 for the next European elections. And we're talking about what needs to be done. We were talking about today was about how everybody thinks, from Gary Stevenson upwards and downwards, that wealth taxes are the answer to the problem. Now, I think, of course, we have to tax the wealthy. Of course, we have to tax the rich. Of course, we have to tax those fixed assets that we can tax. But in a world of capital mobility, you can't tax the rich. It'd be crazy to invest their gains in property in London. What they're going to do is invest it in BlackRock or something, some other institution, right? And they're going to keep their financial assets well away from HMRC and from you and I, basically. And anyway, wealth taxes are not going to generate the income we need to tackle the climate crisis. We need the Bank of England to provide the resources that the state needs in order to tackle the climate crisis. And I was reminding them that in 1945, Britain had public debt to GDP of something like 250% to our income. We had spent 6 years in a very destructive activity of war. We'd sent all of our productive workforce out to die in a world war. And as a result, we built up this massive imbalance in our public debt. At that point, the Labour government started to spend. They built the National Health Service, they built a National Education Service, they nationalised the coal mines, they built housing, they spent money galore. And what happened to the public debt was that it came down from 250% of GDP to 20% of GDP, and it remained at that level until Thatcher arrived, and she pushed it up again, but that's another story, right? The point is that the Labour government invested in generating employment, essentially, in all those good public services, which in turn generated income, which in turn generated tax revenues, which enabled them to reduce the public deficit, right? But it could only do that with monetary resources provided by the Bank of England. We couldn't buy American goods. We couldn't buy goods from countries with currencies that we did not hold. So we had to concentrate on the domestic economy. And we built autonomy in that sense with using the Bank of England and the Treasury coordinating, working together to generate the resources that enabled the Labour government to spend all that money, right? And there were very severe restrictions, of course, precisely because we could not afford to import stuff. And so there was a period of austerity, but that was austerity due to the fact that we couldn't bring stuff in from abroad. But for me, that's the model. And at the time, between 45 and 71, nobody questioned the idea that fiscal and monetary policy should work together until the neoliberals came along and said, no, let fiscal policy take all the burden and let monetary policy be for us, for the finance sector, for capital markets. We want it to be working we want central banks to be working for us, not for the domestic economy. And that's what they do. That's what we're doing. So we've got to bring that back. But until we talk about monetary and fiscal policy, we're not even asking the Bank of England to do what it's supposed to do, which is to be the foundational power of the state and generate the resources we need to tackle climate breakdown. So, I feel kind of, if someone talks to me about the fiscal rules again, I think I'd just scream at them, really.
Okay, so probably got time for 2 or 3 questions. So the question, just for the sake of the recording, is what do you have to say about the probability of a future nature or a future climate-induced financial crisis?
Right. Well, can I just say I have a Substack, which if you had read it at all, and I can't see many of you have, so I chastise you for that, you'll see that I'm arguing that the crisis is imminent, really, together with Daniela Gabor, who's arguing that, the iceberg is in front of us. But we're told not to look at it. First of all, financial imbalances are so vast, they're not sustainable. Back in 2005-06, when I was writing the book, global debt was something like 210% of GDP. And of that, private debt was a much larger chunk than public debt. And the same happens today, and I should have had the numbers with me. Today, public debt is 93% of GDP. In that sense, public debt is entirely sustainable. Just forget about all the doomsayers on that. Private debt is something like 147% of global GDP. And my book is based on the simple arithmetic that if you generate far more debt than you can generate the income for repayment of that debt, the moment comes when people stop paying and default on the debt. And it just seemed to me so blindingly obvious that was going to happen. And it's a simple metric. but it's clear. So it was 210% of GDP in 2006. Today, it's 235% of GDP, and the private sector share of that is greater. And then you see what's going on with AI and the crazy, crazy, crazy numbers of debt built up there. And what's worrying me about that is that they're not generating enough of their own cash, and they have loads of cash. They have billions and billions of dollars of cash, enough cash to go and fight New York State elections in New York this last week and put millions into that. They've got loads of cash, and they're starting to borrow. And that's bad enough because they're building up the debt without any absolute certainty that they will have the income that generates that debt. And then there's companies like Musk's outfit, which is it's a joke really, it's a total Ponzi scheme of merging two companies making losses with one, the satellite company, which makes profits really. So he's making something like, is it $9 billion of losses a year? But he's persuaded, so it's bad enough that he's borrowed money, and he has borrowed very expensive money. He borrowed a huge bridging loan to buy Twitter, and he's just borrowed some more money now to pay down that Twitter loan. But what he does is what Trump did. So Trump bought three casinos consecutively in the 1990s. And he didn't use his own money to buy them, of course. He borrowed money from the banks. But then, of course, he defaulted on them. And he'd borrow money from the banks, and he would take a load of that money and put it in his own pocket. He failed to invest in the casinos, and they gradually degraded. The last one went bankrupt 3 times. But when things got bad, he did what AI companies are doing now. He turned to shareholders, he turned to the stock markets, and he turned to the bond markets. And when they do that, you know that they are shifting risk onto, I don't want to call them the little people, but they are retail investors. And they think, oh, this is big, big stuff here, and I'm going to make loads of money out of this. And some of them do, of course. But actually, it's a sign that they are failing, and they're having to turn to the stock market and to the bond market to raise further finance because they cannot afford to raise it from the banks. And so I think that crisis is about to blow. It's very, very close. If it's also accompanied by a climate crisis, some catastrophic event. Do people remember Hurricane Sandy? I'm just amazed that Wall Street survived Hurricane Sandy, really. But you could have some catastrophic event like that, which could wipe out big organizations. But these guys are behaving as if nothing could deter them from doing that. Now, when I say that, I've also argued that, of course, states have become bailout states, and the Federal Reserve or the Bank of England or the ECB or the Bank of Japan are going to just bail them out. But this time, what happened in 2007-8 was the banks didn't know that they had on their books a load of household debt because they'd bought these fancy derivatives in which the household debt was buried. They didn't know they had those problems, and suddenly those problems came and hit them in the face. And the same is going to happen to AI because the implication of all the borrowing now is not just on the banks, which are more or less guaranteed by the Fed against failure. They're too big to fail. But then there's all the investment in infrastructure, there's all the investment in real estate and so on. All those sectors are going to go down. And can the Fed, again, bail all of that out? I'm not sure they can. So, I'm really quite scared about the way things are going at the moment. And I'm scared that we are not conscious enough of the risks and of the dangers. And that's not accidental. As Daniela says, the iceberg is in front of us, but we're encouraged not to look at it. And there are 2 icebergs. There's the climate iceberg and there's the financial iceberg.
Are pension funds understating climate risk with a kind of caveat that they do acknowledge that they might not have all the data? And the second was, should fiscal rules kind of come after the plan, not before, when you're thinking about industrial policy?
If you rely on fiscal rules, the whole point of fiscal rules is it's designed to prevent the public sector. It's designed to crowd out the public sector and crowd in the private sector. That's what fiscal rules are for. So you've got to get rid of them. You can't talk about keeping fiscal. I mean, the whole point about fiscal rules is that it's limiting how much a government can spend. So you're going to need all that money before to invest in, first of all, your industrial strategy, right? You can't wait to have the industrial strategy and do the stuff and then go and ask for the money. You need it first. And honestly, the Bank of England has the power to rate. You know, the Bank of England, I'm hopeless on numbers, but I think the Bank of England has created something like £865 billion in new money since COVID, right? That's a load of potatoes, really. And it has the power to do that. Why does it have that power? It has that power because it's backed by 30 million taxpayers. It's backed by a treasury that has coming into the treasury by law revenue every year. No company has that kind of power. No company can say, I'm guaranteed that for the next 30 years, people are going to be paying their taxes, right? And that gives the Bank of England enormous power to create new resources. But the Bank of England at the moment is determined not to. So what we have at the moment is monetary and fiscal policy fighting each other. They're opposed to each other. The Bank of England is, with its quantitative tightening processes, is actually saying, I've got bonds on my balance sheet that if I were to sell them, I'd make a loss. So I am going to sell them and make a loss, and I'm going to make the British taxpayer pay for that. And the Chancellor is saying, whatever you say, Mr. Bailey, right? Pathetic. What the Federal Reserve is doing is saying, well, I've got these bonds, if I were to sell them, would make a loss, so I'm not going to sell them. I'm going to keep them until they mature after 30 years, and then think about, what they'll be worth. So we have a situation where we have hostility between these two arms of the financial system that are fundamental to your industrial strategy.